Morning, everybody. It's Herb Morgan, Monday, July 29th, 2024, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. You can follow me intra-week on LinkedIn, Herb Morgan, or on X at ETF_strategist. Presentation you're seeing and or hearing is prepared and created by us and SEC registered investment advisors for use with investors or financial advisors, but each are expected to make their own investment decisions. Nothing contained herein should be treated as investment advice, no tax advice, no recommendations for the purchase or sale of any security. Everything is strictly for informational purposes. Its accuracy, adequacy, or completeness is not guaranteed. Well, we had a mostly down week last week, but if you look, what's significant is the rotation that we've been talking about for about 3 or 4 weeks now is continuing. That is money flowing out of large cap stocks, so market going down. But if you're not paying attention, you would think stocks are going down. Are stocks going down, or is it a rotation? S&P 500, large cap, big cap, heavily tech weighted, down about 0.8%, but look at mid cap up 2, and small cap stocks, we've been talking about this for a little while, up 3.5%. International markets down a little bit, emerging markets down, China taking it on the chin. For those of you that were paying attention, you know we've been invested in China for some time with some strong fundamentals, some strong consumer growth, but sentiment just has not improved there. And in fact, the economic animosity between the developed world and China, specifically the United States, our view was it was time to exit. So we did exit that China position last week in your portfolios. Fixed income markets were higher across the board as interest rates went just a little bit lower last week. So we got the flash readings from S&P Global. That is a reading they put out kind of the almost final week of the month before the final reading comes out after the end of the month. We will get final readings on S&P Global manufacturing and services this week, but for whatever reason, a week in advance they put out a flash reading. It's usually pretty close. It's competitive reasons. They had a competitor putting out readings, a day or two ahead of them. So now they do the flash reading or preliminary before the month is over. And they say that in July, manufacturing declined. You can see it over here on the right, 49.5. Anything below 50 is contraction. Doesn't necessarily mean recession. You see it for months and months on end and big numbers below 50. So it was disappointing. If you remember, we had the conflict between Philly Fed and New York Fed last week, where one was up and showed great expansion in manufacturing and one showed contraction. That's probably reflective of that. Nothing to get particularly worried about or wring hands about. On the other hand, services, which, by the way, manufacturing about 15% of the U.S. economy, services about 85% of the U.S. economy. The services reading, the flash reading, went to 56. The estimate there was 54.9. We haven't had a reading in this level for more than 2 years. So that reading, and then it's consistent. It's 1, 2, 3 months really up there in that 55 range for the largest sector of the economy. If you divide it between manufacturing and services, this shows the economy starting to reaccelerate at a time when we're asking when is the Fed going to cut interest rates because we're worried about a deceleration or recession because of the higher rates, because of the balance sheet runoff and the reduction in the money supply that occurred during that period. So this just shows really just the opposite. Moving on, we had some real estate related data, residential real estate, important to all of you if you own a home or you're thinking about buying a home at some point. Existing home sales continue to just plummet. 4th straight month, dropping 5.4%, more than the estimate of 3.2%. And you can see an annualized pace 3 or 4 years ago, 6.5 million at the peak. The annualized pace now well below 4 million. I think this final sell-off, or this final drop-off in the number really has to do with the expectations that the market has that, okay, rates have peaked. They're going to come down. The Fed's going to start cutting, whether it's in September or November. I still think November. regardless, people said, well, why don't I just wait till interest come down a little bit? It would be cheaper to finance. Who knows? Maybe prices are higher then. Don't know what the total balance will be, but that number certainly was not good. I've mentioned this over and over. Residential real estate, tip of the spear when it comes to rate hikes or rate reductions. They are the amplified beneficiary of those actions. New home sales fell another 0.6% to an annualized pace of 617,000. The estimate there was 640, so that was a disappointing number. So again, the real estate industry, residential, and all the periphery industries definitely hurt by the rate policy, and waiting, of course, for that to be at some point reversed. On Thursday mornings, as you know, we get the weekly initial claims for unemployment. That report came out and said that weekly claims were at 235,000, right in line with the estimate of 238,000. Continuing claims, which had been kind of ticking higher, giving us concern or giving us notice. We're like noticing it, not ready to be, oh my gosh, we need to cut rates. That number kicked down a little bit. So that was a positive. These numbers, whether they're 235 or 200 or even 250, are very low. It shows the signs that the jobs market has remained resilient, even in the wake of the higher interest rates and the roll off of the Fed balance sheet. The big surprise number last week, and this was really an important number, was that second quarter GDP rose, and the pace it doubled, 1.4 to 2.8%. 2.8% for the world's largest economy, nearly $30 trillion economy, is really big. That's a massive number. And the first thing I see when I see that was maybe there was big government expenditures or bigger government expenditures, because remember, GDP is consumption plus investment. That's capital investment, plus government spending, plus exports minus imports. So when I looked through it, I was really pleased that it was personal consumption, because that's the most valuable component of GDP, in my opinion. Gained 2.3% after gaining 1.5% in Q1. Inventories and government spending did add to GDP. Don't get me wrong. But now we say, well, what's it tracking for the third quarter? And I follow something called the Atlanta Fed GDP Now. They take the economic data that's released that day, they add it, and then you're tracking to what they think the GDP report will likely be. The further you get into the quarter, right? We're kind of at the end of July, so we're a month in now. The further you get into the quarter, the more accurate it becomes. But still, to see that number up at 283 this morning is quite impressive. And here is that part of the GDP report that I thought I'd pull out and show it to you. It's final sales to private domestic purchases. This tells you the true health of the American consumer, which is the driver of the American economy. And as you can see here at 2.6%, it's strong. It's very strong. So the question of should the Fed cut interest rates with inflation still sort of, above the target, coming down, that's healthy. We're going to address that and talk about it in a little bit. But with these kind of numbers here and the employment situation strong, in my view, absolutely no reason to cut rates in September, other than, maybe to help a political incumbent. But I don't see that. The current chairman was appointed by the last president and is critically focused on maintaining the view that the Fed is independent and not political. Therefore, without compelling reason to cut, I don't think it's possible in September, though the futures markets are saying something very different, and I am completely the outlier here in this view. Another data point that came out of some of these reports here is retail sales backing up food auto. This is, again, I'm just pointing to the strength of the consumer. As you can see here, accelerating in the last 2 months, up 3 of the last 4 months. Strong consumer. The consumer remains strong because employment remains strong. We also got durable goods last week. This was kind of an outlier report. It showed a big drop. Durable goods orders dropped 6.6%. They were estimated to go up 0.3. So should we be panicked? No. When we look through the report, we see transportation, which is massive aircraft orders, dropped almost 21%, with non-defense aircraft dropping 127%. don't ask me how something can drop 127%, right? 100% is zero, but that's what they put in the reports. That's what I'm sending uh, to you. This is a volatile series, as you can see. So again, I'm not sitting here going, oh, I'm worried the Fed needs to step in and cut interest rates. Not time to do that. More on personal income for June, up 0.2%, a little bit below expectations. Spending up 0.3%, right in line with expectations. So again, we're not seeing anything to suggest, here's personal spending, right? This is the COVID shutdown. You can see that, but we're just moving along. So then it becomes the only reason to cut rates is that you think now that the neutral rate is somehow below where you are and you're being restrictive, but you have to be restrictive to bring down inflation. So that brings us right into the core PCE and the PCE reading that we got last week for the month of June. PCE, that's personal consumption expenditures, up 0.1%. Core PCE up 0.2%, and the year-over-year gains are 2.5 year-over-year for PCE and 2.6. Those numbers need to go, and they need to come down further for the Fed to have met its statutory mandate of 2%. We're getting there. We're getting close. But you can see before the COVID stimulus, which was excessive, which caused all the inflation, both fiscal and monetary, here's the 2% line. We pretty much tracked below it, which was really good and really desirable. And we would start hiking rates down here before we got to the 2, not till when we got to the 2. We were always preemptive. So why would we start cutting rates now unless we were worried about deflation? Nobody's worried about deflation right now. Okay, moving along, staying on the inflation theme, the commodity CPI, though, has turned negative. That's this yellow line. This is the CPI of commodities. You see that it's negative. The reason I bring that up and I plot it against core PCE, core CPI rather, is see them, they're both dropping. But this one has greater elasticity, pulled it up, now pulling it down. So we think the trend is right. We're not saying that we're not going to get there. I think the Fed has accomplished its goal, but there's just no reason to cut rates until you get the actual prints, and the actual prints go for a couple of months. You're there, right? We've had a couple of good months of core PCE and CPI, but why not go for 4 months or 5 months? And then in November, you can have your first rate cut. In terms of sentiment, consumers are still not feeling too good about the economy. So I'm telling you, hey, look at the services sector, the manufacturing sector kind of moving along. Employment is good. The consumer is spending. Then why aren't they feeling better about it? And the answer really lies in the fact that the commodity price inflation, or should be the goods and services price inflation, is still there. It's sticky. Remember, if we get rid of the inflation, it doesn't mean the prices come back down. It means they just stop going up. And so a lot of Americans really still feeling that, and they are reporting in these surveys that they don't feel particularly good about their situation. Okay, we had an earnings season. I mentioned to you last week that we had, I think it was 125 or 130 names would report. They did. The numbers continue to be good. Of 206 S&P 500 companies that have reported for this season, 162 reported positive, meaning they beat the consensus estimate of analysts, 13 in line, 31 negative. Average earnings surprises just under 5%. Big surprises in terms of size percentage would be materials, but okay, it's only 11 companies so far moving down. 7% from healthcare. Financials doing pretty good. Energy doing pretty good, but across the board, positive surprises. When you look at technology, we have had 17 names, and some of them good. We've had a couple of disappointments, but still the aggregate there, about 3.5% earnings surprise. Lots of economic data this week because we are ending the month of July. Nothing today, but then tomorrow, Tuesday, real estate data from FHFA and Case-Shiller reporting home price indices. Job openings, remember, those are up to 12 million coming out of COVID, continuing to get down closer to equilibrium, but job openings still exceed the number of unemployed, puts upward pressure on wages. Another reason not to cut interest rates in September. Consumer confidence ADP and the Bureau of Labor Statistics jobs reports. ADP would be on Wednesday, expecting that the economy added 168,000 jobs. Chicago PMI, this is a manufacturing reading. Look at that, below 50 estimate. Pending home sales, and the Fed meets. Nobody's expecting a rate decision, a rate change this week. It's really, again, looking at September. But what I do expect is in the statement and the press conference afterwards, I think that Jerome Powell will hint seriously about whether it is September or November, and whether I'm right or wrong ultimately in this analysis. Weekly claims expected low, 236,000. Labor costs, productivity. The final reading, as I mentioned, from S&P Global for manufacturing, and then the same one from from S&P, the same one from ISM, both expected to be below 50 and show contraction in manufacturing. Auto sales, construction spending, the big Bureau of Labor Statistics jobs report. 4.1% is the estimated unemployment rate. What could pull that rate hike forward? A tick up there from 4.1 to 4.243. That would be the argument for pulling that forward to the September meeting. Okay, this is available, as you know, on the YouTube channel, Slaying Bulls and Bears, and available on all the audio podcast formats. Thanks, everybody. See you again in 1 week.